The history of FRS 102, Section 20 leases, its journey and the evolution of lease accounting. The history of changes to lease accounting began long before the implementation of IFRS 16 in 2019, which significantly impacted international and global companies. This transformation was driven by decades of debate and frustration over the lack of transparency in financial reporting under the old lease accounting standard, IAS 17. Now, the UK is preparing to align its domestic framework, with proposed changes to FRS 102 Section 20 leases, bringing UK local reporting standards into line with IFRS 16. These changes, effective from January 2026, represent the next step in achieving consistent and transparent lease accounting across jurisdictions. The journey can be traced back to the tenure of David Tweedy, chairman of the International Accounting Standards Board from 2001. Tweedy famously voiced his frustration with off-balance sheet lease accounting, stating, "One of my great ambitions before I die is to fly in an aircraft that is on an airline's balance sheet." Push for reform. The push for reform stemmed from systemic issues in lease accounting across industries. Critics, including regulators and investors, highlighted key concerns. Lack of transparency. Off-balance sheet leases allowed companies to hide significant liabilities. Distorted financial reporting. Companies with substantial leasing activities, such as airlines and retail chains, could appear less indebted than they actually were. Inconsistencies in comparability. Investors struggle to compare companies with varying levels of lease commitments. The call for change gained momentum in the early 2000s, with global regulators and the G20 urging standard setters to address these issues. The 2008 financial crisis accelerated the need for reform as the crisis highlighted the importance of transparent and comparable financial reporting. Lease accounting was identified as a critical area requiring overhaul. Exposure drafts and industry pushback. The path to IFRS 16 was not smooth. The first exposure draft on lease accounting was published in 2010, but the project stalled due to widespread criticism. Stakeholders, particularly from industries heavily reliant on leases, for example airlines, retail, logistics, and hospitality, raised significant concerns. High compliance costs, operational complexity in implementing the proposed changes, negative financial impacts on key metrics such as debt ratios and earnings volatility. A revised exposure draft was issued in 2013, incorporating feedback, but pushback continued. Stakeholders argued the proposals still imposed excessive burdens and operational challenges. Other standards took priority. The timeline for IFRS 16 was further delayed as the IASB prioritized other major standards. International Financial Reporting Standards 10, 11, and 12 on consolidation and joint arrangements introduced new principles between 2011 and 2013. IFRS 9 financial instruments and IFRS 15 revenue recognition, finalized in 2014 with effective dates in 2018, were prioritized due to their widespread impact. To avoid standard overload for preparers, IFRS 16 was delayed to give companies time to focus on implementing these standards first. International Financial Reporting Standard 16 goes live. In 2016, IFRS 16 was finalized and companies were given 3 years to prepare, with an effective date of January 1st, 2019. The new standard required lessees to recognize virtually all leases on the balance sheet, fundamentally altering financial reporting across industries. Global alignment and local standards. Since its implementation, countries have been aligning their local accounting standards with IFRS 16. Australia and New Zealand were early adopters, reflecting their commitment to harmonizing with international standards. The United States aligned its U.S. local reporting standards with similar principles under ASC 842, effective from 2021. The UK is now preparing to amend FRS 102, Section 20 to align UK local reporting standards with IFRS 16. This change will take effect from January 2026, continuing the global effort for consistency in lease accounting. What accountants need to do now? FRS 102 will now require you to recognize right-of-use assets on the balance sheet, lease liabilities up front, and provide enhanced disclosures. In short, leases are coming onto the balance sheet. And for many, that's going to feel like a bit of a step change. So, here's what you can start doing now. And honestly, doing just one or two of these things will already put you ahead of the curve. First, start identifying leases. Not just the obvious ones. Dig out the vehicle hire agreements, the copier contracts, even those bundled service deals that might include a lease component. If it walks like a lease, it probably is one. Second, get a grip on the transition options. There are choices to make, and the earlier you understand what works best for your business or your clients, the easier life will be. Third, take a look at your systems. Will spreadsheets still cut it? Maybe. But if you're managing dozens of leases or trying to keep track of changes mid-contract, you might want to explore some smarter tools.